Hi, friends. Welcome back to the Skinny on Wall Street with us, the Wall Street Skinny. I'm Kristen.
I'm Jen.
And we are, I think, 2 days now into an official government shutdown. So we are going to, in the Skinny on, talk a little bit about the government shutdown and the effects that it's having on the markets. Like, we did not have a jobs report today, so there was no non-farm payrolls. And so that is obviously causing issues on the street, right? It's causing some issues with traders. And so we're going to get into, obviously, the impact that the shutdown is having on Wall Street. Some other, huge announcements in the private equity leverage buyout world. So the largest LBO in history just was announced. So EA Sports, previously holding the title, was TXU from 2007 when Jen and I first started our careers. And so it's funny, there was a Bloomberg article about is this 2007 all over again? Are things getting a little frothy? And so we're going to touch a little bit on, like I said, the parallels between the EA Sports LBO and the TXU LBO. And then finally, last week, we touched on I think there was a report, the Dallas Fed president came out and said that they wanted to look into possibly ditching Fed funds. And since then, it's actually almost taken hold. There's been a lot more serious journalists who are writing about that. So Jen's going to do an even bigger deep dive into that. So that's what we have coming up today. Before we get into that, Jen, I don't know, do you want to talk a little bit about just the fixed income sales and trading class and all the kind of fun stuff we have coming up?
Yeah, so really quick housekeeping here, guys. Our pre-sale for our fixed income sales and trading self-paced course is live. What you get if you buy it at pre-sale is you get part 1, which is bond math basics, which is 2 or 3 hours of content, and you get that today. Over the next 2 to 4 weeks, part 2, which is derivatives, which goes, I think there's 9 modules alone on interest rate swaps. It gets into credit default swaps. It gets into mortgage pass-throughs. We talk about FX. We do a lot of work on options. That's going to come out in about 2 weeks. And then behind that, 2 weeks later, you'll get part 3, which is macro and relative value theory. And then we'll get into all of the actual trading strategies that the biggest investors in the world put on. So that'll be coming behind that. So again, if you want this course and you buy it at pre-sale, you will get the best pricing that we are ever going to offer. Prices are going to go up as soon as all these modules are out. And then in 2026, they're going to go up again. So that's one thing. Kristen is working on building out a 3-statement financial modeling self-paced course. So you are going to be able to get that next month, most likely. I think we'll be launching that at the end of November, hopefully around Black Friday. We're going to see. We might have some exciting stuff coming. But if you are you know what? I need to get trained up and I need to become an expert in financial modeling. We have our live virtual boot camps that you can plug into. And this isn't just for everyone who's in college. This is really for people who are on the desk somewhere, whether you're in a P&L generating role, whether you're actually on the desk at an investment bank or at a private equity firm, or if you are someone within an organization who wants to understand how this stuff is done, and it might not be part of your role, ask your people internally to get you signed up for this, or sign up yourself and ask your firm to reimburse you. This is the best crash course education you're ever going to get on this. It's live with Kristen and me. And I'm going to be asking all the dumb questions to slow her down and make sure that if you're not someone for whom this is intuitive, that you get this in our classic delivery style of hey, listen, I'm the dummy. Please walk me through this, slow it down, break it down for someone who might not necessarily understand this. And this is going to be exactly what you need to fill in all those gaps in your learning. So this is at the end of the month of October. It's on our website. Go to live classes and be sure to sign up for our financial modeling virtual boot camp. We've already had, I think, 2 or 3 of these. We're doing our global markets and investing playbook on Monday. That is sold out. So this is the next class we have coming up. So we really want to see you guys there. Okay. So with no further ado, let's talk about the government shutdown, because I think that this is something that's really interesting. The last time the government shut down, I actually wasn't in the markets at the time. And government shutdowns had been threatened a number of times while I was in the seat. But here, if we look to history, what happens with the government shutdown and why does it matter? So what happens with a government shutdown is a number of different things. It's not
let's just start with yeah. Well, I wanted to start with just what does the government shutdown do? I think that it's important to understand that the government shutdown, the thing that's wild about this is that it's almost you've already ordered the food, you're at the restaurant and now it's the bill came and you're nah, I don't think, I don't think I want to pay this. So right now what's going on is, look, the Republicans passed their big, beautiful bill and that is what it is. But now there is an impasse about actually like funding the budget that's been passed. So this happened, to your point, it happened under Obama, it happened under Trump, and it's always been, honestly, usually it's been the Republicans who have held it up, but now it's the Democrats. The politics like kind of don't matter, but the point is that people are fighting about actually paying for the stuff that's already been decided. So like this is why I have such a big problem with this. Like stop it, guys.
Yeah, so that's a great point. So what happens when the government shuts down is it's not like everything grinds to a halt. If you are deemed essential personnel, you still have to come into work, but you don't get paid. You will get paid when the shutdown ends. But last time we had this happen, it lasted for about 35 days. So what are the knock-on effects of that? Well, first of all, when the government shuts down, because these non-essential personnel are not getting paid, two primary things happen. One is that these aren't the hedge fund billionaires not getting paid, right? These are people who are potentially living paycheck to paycheck. These are everyday contributing citizens in the economy. So we see that immediately pass through into kind of day-to-day consumer spending and things like that. But two, right, I think a bigger thing is eventually they stop showing up because they're like, hey, listen, I was cool with it for a day or two, but like once you get through 2 weeks and that paycheck doesn't hit, it's like, what am I doing, right? So then it has knock-on effects additionally throughout the broader economy of not just the purchasing power of those individuals who aren't getting their paychecks, but if you're a TSA agent or if you're a flight controller or whatever, and all of a sudden we need to start shutting down flights and all of a sudden people aren't traveling and all of a sudden the national parks aren't open for business and all these things, then it starts to really flow through. Number two is that I think that there is a little bit of broader speculation that President Trump will use this shutdown to potentially actually lay off more government workers behind that. In an environment where we are already seeing very little job growth and job creation, we may see an additional impediment to the labor market, which is already effectively stagnant. And that's what's led to the Fed's decision to cut rates. So beyond all of that, right, let's look to the past and think about what that means in terms of the markets. So historically, if we learn from the previous precedent, what it means is that all else being equal, rates rally because we're anticipating, again, less spending, we're anticipating a softer job market, and the dollar gets weaker because we're assuming that that's going to flow through to easier monetary policy. So I think the overall landscape is one where, okay, this does not signal good things for the economy in general. Now, add to that the backdrop of the fact that we just had a Fed meeting. We've got another Fed meeting coming up. And it was like, okay, this is going to be a really, really important set of data that we get over these intervening weeks to give us a good sense of what the Fed's next move is going to be. Well, it's Friday, October 3rd. And this is a payroll Friday where every single investor and trader who cares about economic data should be glued to their seats. But guess what? There's no BLS data report. There's no non-farm payrolls report today because that part of the government is shut down. So we're missing critical pieces of information that go into the Fed's decision-making process. So Kristen, you sent me an interesting article this morning about how increasingly investors and traders are now looking to various private payroll data sources and things like that to try to suss out the information for themselves. But the bottom line is there's not going to be any good information because you have to now project forward from the likely impacts of this shutdown. So none of this is good for labor. None of this is good for the economy. It all signals a higher likelihood that the Fed is going to need to take more extreme action. So if we look to the past, again, that's how most people are thinking about positioning because we want to take those lessons from the past and apply them to today. By the way, seasonally, this is supposed to be a good time for risk assets. You tend to want to buy in October and hold through the end of the year. So how are we going to support those seasonals if we don't have the underlying economic data that's going to be good?
Well, and I also think like this does impact also people's desire to do things. I mean, I know my cousin's parents were supposed to come to Massachusetts and like they have a flight from California and they messaged us. They were like, I think we might cancel because we don't want to get stuck with like, not having the planes land on time because like TSA starts to get cut and all that stuff. So to your point, Jen, this is going to have a potential knock-on impact to the economy if it is not like wrapped up in a quick fashion.
2 weeks tends to be like that fulcrum, that turning point, right? If we can get it resolved before 2 weeks are up and before that first paycheck is missed, it's a lot better in terms of like the expected outcome versus once that first cycle of paychecks is missed. What?
No, I was gonna say, and I don't think that it's gonna get resolved in that time frame.
Yeah, I just simply don't know. So,
Well,
anyways, that's what the markets are doing. I think there's a lot of people who are, not necessarily killing themselves to get to the office right now.
Well, yeah. So I had heard, I mean, I was listening to like the Pivot podcast this morning, and they were saying that there's a number of people who are like, we want it to last 47 days because Trump is the 47th president. So like, I was like, well, how about we
don't
don't? No,
we don't want it to last. We
don't want it to last at all.
Let's go.
Yes, we want everything back to normal. Well, and actually, even knock-on effects to that, there was something that came out. There was an article about how like it could impact IPOs because, by the way, it does impact the SEC, and like there's a lot of other knock-on effects that people might not be thinking about.
But, so sorry. Like maybe that's not so obvious to everyone who doesn't have the corporate finance knowledge that you do. Why is the SEC such a critical path thing for IPOs?
Well, I mean, the SEC, Securities and Exchange Commission, when you want to go public, you have to file what it's usually called like an S1 or a prospectus with the SEC. And now exactly what the SEC does on the back end, they have to approve stuff. So I think that, again, the lack of people working and getting paid at the SEC, because they're not necessarily essential, right? But this could impact the IPO pipeline because IPOs are starting to come back a little bit. Related-ish, I guess. Like, let's.
It's okay. You don't have to find an artful transition. It's okay. You can just be like, next topic.
Well, yeah, next topic. So we want to talk a little bit about the largest LBO of all time, which just got announced, the leverage buyout of Electronic Arts. So as I mentioned, right, Jen and I, we both started on the trading floor. Well, Jen started in 2006. I started in 2007. But I walked on the trading floor right 2007. And that was the year that KKR, TPG, and Goldman Sachs Capital Partners did one of the largest leverage buyouts in history. Basically, TXU, Texas Utilities, later named Energy Future Holdings, they did a leverage buyout that was roughly about $45 billion if you're looking at the value of the entire firm. Now, by the way, sometimes you'll hear people throw out different numbers. Like I saw other people saying like the largest LBO was $30 billion because they were looking at the equity value. Again, when you're talking leverage buyouts, people tend to prefer to look at what is the value of the entire business, both the equity and the debt, because when they do the actual leverage buyout, like again, the debt and the equity are both very, very critical. But this was from like a financing standpoint, just like your sort of textbook pre-crisis leverage buyout, how it was financed, the club nature where you had these three different best-in-class private equity firms coming together, like pooling their money and essentially putting up $8 billion of cash in the form of equity to buy, again, that $45 billion firm where the rest of the purchase price was $36 billion, and that was funded with debt. Now, when I used to teach like Leverage Buyouts 101, I would frame it in the context of, let's look at these large deals. As you're thinking about how this is financed, you have bank loans, you have subordinated debt, you have like your high yield, whatever. So the components of the actual leverage buyout, the structure was kind of very typical. And what's interesting about the Electronic Arts leverage buyout is just how different it is, despite the fact that it looks very similar. And actually, it's so funny because one of the other, I feel like, nuances about the deal with TXU is, spoiler alert, it also became one of the largest bankruptcies of all time. So, details. But so again, a couple of interesting things. Let's talk quickly about the Electronic Arts LBO, and then we can get into some of the like similarities, differences, and what are some of the main takeaways. The main takeaways for me was like how private credit has become such a key player, and also the sort of lack of this club deals. Like it looks like this is a club deal, but it's actually kind of not. So anyway, let's fast forward to today. So Electronic Arts, they are the makers of, I think it's like Madden. They do gaming, right? They have a whole bunch of various games. Video games, exactly. A consortium of investors. You have Saudi Arabia's PIF, that is the sovereign wealth fund of, again, Saudi Arabia. They have over $1 trillion in assets under management. They have combined with Silver Lake Partners, which is a classic mega fund, and Affinity Partners, which is basically Jared Kushner's private equity firm. And they are now obviously part of the largest leverage buyout in history. Now, TXU is number two. But a couple of things that are interesting about this. So number one, the equity check is actually quite large. So when we talked about TXU, we said that the sponsors were putting in $8 billion of equity and $36 billion was in the form of debt. that equates to like the equity check was almost whatever, 17, 20% of the investment. Now the equity check from the sponsors is $36 billion and for a $55 billion valuation, but the amount of equity they're putting in represents actually almost 65%. So 65% to like 17%. So they're putting in a lot more cash, a lot more equity in the financing of this deal. Now, from a leverage standpoint, meaning like, okay, let's think about how we, think about the debt. People don't really think about debt typically when you're doing a leverage buyout as what is the percentages. That's more of like, real estate. People think loan to value and like, sure, it's an interesting metric, but usually the metric people look at for these investments in companies is debt to EBITDA, so leverage. So the TXU LBO had roughly 8.5 times what's called last 12 months EBITDA. So that's how much they were levered on a LTM basis. And just like a kind of quick rule of thumb, when you hear someone say the leverage, the EBITDA multiple was 8.5 times, what you're basically saying, like leverage gives you almost like ballpark, how many years would it take you with your current level of operating cash flow to pay down the debt? So if you see that, you've levered up 8.5 times, you're saying you're going to be able to pay down the debt and call it 8.5 years. So that was the TXU LBO. On the flip side, we have now EA, and they're levered up to 7.5, which by the way is actually pretty typical today. There was maybe a little bit more risk appetite in 2007. Now it's a little bit more conservative, right? So 8.5 versus 7.5 times. Again, they're still highly levered, and actually the 7.5 times is higher than what kind of the guidelines are post 2007. I think that a lot of, I don't know if it was the SEC, I forget who had these like benchmarks. They wanted to see leverage buyouts stay under 6 times, but it's pretty typical to, especially if you have a company that's generating significant cash flow, you might be able to get it up to 7.5. Okay, fine. But the other point to note is like, obviously these private equity, they're buying for like 20 times enterprise value to EBITDA, which is obviously quite high for a valuation multiple. So you see that almost like the purchase price of EA from a multiple standpoint is so much higher than the TXU LBO in 2007. So again, a couple of other things though on the debt side. So what's really interesting about this new EA deal is that JP Morgan is solely committing to doing the $20 billion of debt. And actually it's really only 18 if you're talking about, what's funded at close, but that is insane. So typically what you historically saw and what we saw in the TXU LBO is the debt would come from like all the various corners of Wall Street. So what do I mean? So in a traditional LBO funding back in the day when I worked on the financial sponsors group at Morgan Stanley, what you would see is like you would have the bank loans. So the bank loans would be syndicated out to a whole bunch of other banks. So that's called the broadly syndicated loan market. And the idea is, you have all these various banks, right? So you have and actually let me look up exactly who was part of the deal. You have Citi, you have JP Morgan, you have Goldman Sachs, and they basically would like structure this loan, but then they would also syndicate out the risk and they would bring in other banks as well. So you'd have Credit Suisse, you would have Morgan Stanley, and you'd have like a whole bunch of other banks who were all basically contributing to the package of, but 24 billion was in the form of what's called that senior secured loan. So that 24 billion came from like a whole bunch of different banks. Now it's coming from one bank. Sort of, not really, because JP Morgan's not necessarily going to be doing the entire loan themselves. But additionally, back in the day, you would also have the high yield. So they would go out and there would be like a bridge loan because ultimately there was like in this case with TXU, there was going to be $11 billion that was going to be raised via the high yield bond market. So basically going out to like institutional investors where they are buying in at higher coupon rates. This is like the junk bonds that people have probably heard about. And so as part of the financing, when this would happen at the time, you would get bridge loans. So the banks would bridge the gap to help fund the deal in between when ultimately the bank would go out and actually help raise those bonds. Mm-hmm. Today, again, you have JP Morgan who has committed this whole thing. And what's interesting about this is that nowadays, so JP Morgan's $20 billion commitment is, by the way, the largest single bank underwrite for a buyout ever. And unlike in 2007, where it was like, everyone is in the pool, right? This sort of approach. What's happening now is this sort of emergence of private credit. And private credit is basically just like direct lending with one lender. And so JP Morgan, by the way, is getting into or is now involved in this private credit market, which sounds crazy because you're like, wait a second, JP Morgan was like part of the, doing the bank loans. Like, how is this different? Yeah. Well, the difference, you're like, it's a bank, it's a loan. But no, so JP Morgan's, in addition to like being able to sort of leverage potentially the broadly syndicated loan market, they also have in their own right, $50 billion of direct lending that they can actually, like, if they need to, like, they can lend $50 billion off their own balance sheet that is specifically for like this type of investment, like the private credit, as almost like a safety net if they're not ultimately able to syndicate this risk out. And so historically, what we saw in 2007 is, and I, like I said, I literally started on the CLO desk. And so when TXU did this leverage buyout, you had, like I said, the Morgan Stanleys and the Cities and all these different people who were like pooling together, blah, blah, blah. One of the things that they wanted to do is they actually wanted to get all of this risk off of their balance sheet. Now, how do they do that? Well, enter the world of CLOs. So you have all these CLO managers, and what they would do is they would go out, they would buy the various pieces of those bank loans off of the balance sheet of all the various banks. And then you would get this new crop of investors who wanted exposure to like the structured finance market. And that would ultimately get that risk off the balance sheet of the bank so that they could go out and lend more. But now, I mean, JP Morgan, they don't necessarily want to get that risk off if they are like leveraging their direct lending capabilities. So they have a little bit of flexibility for how this is ultimately going to shake out. So the exact like structure of the $20 billion debt package, we don't know exactly what the actual mechanics are. It could be that they decide to like try to tap that broadly syndicated loan market. It could be that they decide they want to, do some whatever high yield financing. Or it could be that this is part of their direct lending capabilities. So there was not information about the exact, like I said, financing of how this $20 billion like gets split up, if you will. But let me pause for a second, Jen, just to see if there's any questions you have so far on like anything related to this.
It's so funny though, because like when you talk about parallels between now and 2007, the question that I always see people asking today is private credit a bubble? Right? And just thinking about, okay, why do banks securitize loans? They securitize loans to get them off their balance sheet, like you said, to make more money, right? This is where bonds come from, guys, right? Like you could just borrow all the money from a bank directly and face them in perpetuity, but then they can't go out and make any other loans. And then they wear that concentrated risk of you as the borrower ad infinitum, right? When banks can securitize things, when they can get them off their balance sheet, it decreases the riskiness of the bank itself. And it then goes out and kind of offlays all of that risk to the investors who choose to participate in these securities, right? When we talk about banks doing private credit and you think about the massive concentration at JP Morgan, who is, if any bank is too big to fail, it's JP Morgan, right?
Yeah.
But who is risking up internally to take this huge underwriting risk. Think about what that means, right? And think about what went wrong in 2007 with the TXU LBO, for example. You talk about these hung deals and things like that. Okay, clearly no one's worried about that right now because there is so much demand for credit, and I get that, but for how long, right? We always feel like things are always good until they aren't. So even just hearing you talk about the concentrated risk to JP Morgan does make me feel more apprehensive about this deal than I otherwise would be if this were just the biggest ever LBO, if it were a more traditional club deal, if you will.
I will say though, we don't know exactly like how, that's what I was like trying to sort of figure out. I was looking at all the various things. Were there any like SEC filings for a possible like bond deal? Was there anything that signaled like, are they like, I assume they are not taking on this whole thing as a, private credit. Because the thing with private credit, like the benefit is there's one lender. The downside is that it's more expensive. So you're paying more. And by the way, like rates are not low right now. So like it's going to make it a lot more expensive versus back to this like broadly syndicated loan market. It's going to be cheaper if they were to leverage that. So to your point, I am curious ultimately what the actual financing package looks like. I mean, I would be surprised if it is JP Morgan literally like saying, hey, you're going to get this $20 billion loan directly off of our books and like, fine. But so we don't know the exact nuances of how they are going to ultimately like divvy up this $20 billion like loan. And it's possible that they do tap the broadly syndicated loan market and they do ultimately, go out and do some debt financing.
So we just need more information on that front.
Yes, we do.
Got it.
But the thing that I think was so interesting is the fact that like, if something goes wrong, they still have that they can fall back on, Whereas again, in 2007, there was like fire sales because again, like when I was like on the desk and looking at with CLOs, the way that it works is like you would have the warehouse. And so you would have all the various different bonds that were like in
Can you explain what the warehouse is for people who don't know this terminology?
Yeah. So essentially, so what happens is banks would help buy loans for the CLO manager. So the CLO manager, call it your KKR, who's going to be like literally managing the pool of loans. And they would help to start going out and buying these loans in what's called a warehouse facility. That ultimately, when the CLO priced, right, where you have all the money coming in from other investors who are interested in buying into structured products, that would then get those loans off the books of these banks. And what ultimately happened is, right, in 2007, 2008, like I was literally working in the CLO desk. And I mean, obviously, like it all dried up. Like nobody wanted any of those structured products because, by the way, the people that were investing in the structured products, like CLOs, were also investing in the asset-backed security shit. That's like the crap that blew up. Thank you, Lehman Brothers. But like all the crap that the mortgage-backed securities where you had like CDO squared and like it would be like you're buying pieces of other CDOs and like all this crazy stuff. So the buyers, like you had all these forced sellers, you couldn't go out and you couldn't do a CLO because the buyers all went away. Same thing that I saw happen.
Think about it this way, guys. If you were a car manufacturer, right? And you anticipate that everyone is going to want these cars, right? You've got all this indicated interest that everyone's going to want these vehicles that they can drive off the lot with tomorrow. What you would do is you would go out and get all the parts with which to build them, right? And you would go get I don't really know much about cars. Like I probably should have used something else as an example, but you go get the leather seats and you go get the steering wheels and you'd go get the tires and whatever it is, right? And you bring them all to your warehouse to assemble them. But then if everyone who put it in order for your Audi, your Toyota, your Lexus, whatever it is, says, actually, you know what? I don't want those cars anymore. Then you've got steering wheels all over the place. And you're like, what the hell do I do with 8,000 steering wheels?
Yeah.
So that's what effectively goes wrong with this warehousing model, which was, by the way, a cash cow for these banks when things were good in the boom. Because by the way, banks make money through that warehousing process. They don't just do that for free. They don't just say, hey, I'm going to keep these things here for fun, just as a favor to you guys, right? You know, again, it really simplifying this down, you buy the thing at 80 cents on the dollar and you're selling it at 100 cents on the dollar to the people who want the finished car product, right? Just the same way there's markup on all these things that come into a physical product warehouse, right? So that carrying cost over that time is worth something to someone and you are charging for that. So that is how this model used to be. Rinse and repeat for these banks.
Well, they're also getting paid fees to like do the CLOs. And so, yeah, exactly. And actually, I want to make one other point, which is funny, right? I saw an Instagram. Oh, you sent it to me. You sent me an Instagram video of someone who's like, oh my God, like the next big thing is like the CLO market's going to blow up. And I was like, no, like, so I do want to make this one point. Like people bucket like CDOs are all toxic and terrible. And like the thing that's different about CLOs is collateralized loan obligations, loans to a bank, from a bank, like the banks are making sure that they're going to get paid that money back. So there's a lot of covenants and protection that is put in place with these CLOs, with the underlying loans that
with the loans at origination.
With the loans themselves. Like assuming a company goes bankrupt, like again, TXU, the actual lenders themselves in a bankruptcy proceeding, usually the recovery is like 70 cents on the dollar. So there's only so much you can lose with the underlying loans that are part of the CLO. The other thing is that, you think about what happened in 2008, where you had all of these, like, again, the garbage that got blown up. Those were what I call second order securitization, in the sense that mortgage-backed securities are already pools of all these other mortgages of all these like people who are buying all over the country. And I mean, the subprime issue where like you could get, Jen, I think you called it like a ninja loan, like no job, no income, no assets. Like you could literally be like, yeah, no, believe me, trust me. So the actual underlying collateral in those CDOs and in the mortgage-backed securities, the asset-backed security stuff was bad. That is not the case with CLOs. Not only do you know all the loans that are going into this, the covenants that are in place with these loans are pretty strict. And by the way, I mentioned how like leverage levels have actually come down. Yeah. And even in 2008, I think you did not see significant defaults in the corporate market And so, I mean, people who were investors, I mean, they made out like bandits because you had these forced sales. It was amazing. And by the way, a lot of these private equity firms who are the CLO managers, they often are taking the equity piece in the CLO, like they're taking the riskiest part. So they also don't want to lose their short either. So it's quite different, I would argue. And there are not the same parallels to what happened in 2007 in the CLO market. Now, private credit, to your point, Jen, I think is a different scenario. And people are talking about that potentially being a bubble. I disagree on the CLO market. So I just wanted to make that little point because that really pissed me off, that video.
Too, like going back to where we started this conversation, you mentioned that article about where we are seeing defaults, right? And they're on consumer loans, they're on auto loans, they're on things that are, a much more a reflection of the American household balance sheet. We talked about this with Matt Hornbach 2 weeks ago about how the 2008 crisis was a crisis of the levered American homeowner.
Mm-hmm.
Now, where is this leverage concentrated? Is it at banks? Is it as corporations? Or is it so heavily concentrated in Americans who have taken out loans to whatever, credit card debt and auto loans, right? It's just a very different cohort of things that are showing signs of stress versus an environment where credit spreads are at all-time tights. So you talk about rates not being particularly high, but the additional borrowing cost to a company to borrow.
Oh, no. The rates are high. I mean, they're not high.
They've come down 150 basis points from where they were, right? So those borrowing costs have cheapened considerably over the past year or two. And so there is a much better environment when credit spreads are low than I would argue borrowing costs were in 2007. Rates were higher in 2007.
True. Fed funds was 5.25. I think it's between 4 and 4.25 now.
Mm-hmm.
So rates, at least on the Fed fund side, is about 100 basis points lower.
In private credit, we're always told that the covenants are more restrictive in private credit, but okay, you say so. I don't know, right? As an outside investor, I can't invest in those loans. So how do I know?
Yeah. Okay. But to your point, I will say the thing with loans is if rates do come down, then the cost to the borrowers comes down as well because it is floating rate, unlike bonds. But anyway, this is sort of neither here nor there. I think that the main takeaway though is that the private credit angle with this huge JP Morgan style possible, I mean, I still don't think they're going to do the whole thing as one large loan. I feel like they're going to somehow split up. We just don't have the information about what exactly the structure looks like. But it is very interesting that JP Morgan now has that ability, right? Because it's funny. You always think of the bank just lends them the money. And it's no. Literally that risk gets parceled out and distributed across all the various, corners of Wall Street. And now it is with the private credit, potentially much more concentrated, which was exactly your point. And by the way, if you think about the TXU LBO, I mean, that there was a bankruptcy and people who were buyers in CLOs, they did fine. And also if you were a bank and you had lent to TXU, you've also probably lent to a bunch of other firms. What was the one, Caesar Palace Coup, where they did declare bankruptcy, but then they got a ton of money. So there's tons of different companies. And again, that diversification does actually, help. That's the whole idea with a CLO itself. Whereas to get to private credit, right? One large check, it's not diversified. But a few other things that were interesting and notable as well. So what's interesting here was that, look, in 2008, you saw an $8 billion equity check that was a mix of, 3 marquee, super prestigious private equity firms. What's happened since then is you see less of what's called those club deals. Now, you might say to yourself, well, wait a second, I thought you told me that it was Affinity Partners and Silver Lake and PIF. Yes, but here's the thing. Right. Only one of those is probably a very skilled operator, and it is Silver Lake, right? Silver Lake is your marquee, prestigious private equity firm that has that, history of operating businesses, blah, blah, blah. Because one of the things that happened is there was a lot of issues in pre 2007 when it came to almost what direction should we go? You had, and we saw this actually in the Caesars Palace Coup, where I think was it Apollo and TPG, who were the two private equity firms. And there was a lot of butting heads about how they wanted to run the business. There was a number of lawsuits and all that kind of fun stuff. So what's more typical now is what we see sort of in this example, which is called co-invest, meaning you have one private equity sponsor. So in this case, again, the Silver Lake, who is doing a deal, but they don't have enough, even though they might have, and actually I should have looked up what their most recent fund size was. So,
They're huge. Yeah.
10
they got money.
Well,
they got money at the wazoo.
But I mean, like, let's say they have even a $25 billion latest fund, which is sort of the cap that we've seen. Even if they have raised a $25 billion fund, A, they're not going to put all that money into one deal.
One deal, yeah.
And B, like $25 billion is not the $36 billion that they need to put in. So what happens is you see a lot of these private equity firms going in and writing an equity check and then finding an LP, right, one of their limited partners who historically would be investing in one of those funds, paying 2 and 20, deciding, you know what, I don't want to do the 2 and 20 thing. Let me just go in alongside you. You run the business, but my capital is coming in to shore up the investment that you're going to make. Now, I was talking to someone because they had said, let's think about the motivations here. So you have PIF. So again, Saudi Arabia's sovereign wealth fund, a big thing that they have done, obviously historically, is they are obviously trying to change the image of Saudi Arabia. They have Live Golf. They've invested a ton of money. They were signing, I think they offered Tiger Woods like $800 billion to like go sign with Live Golf. They have money and they want to put it to work. What's interesting about this, the video game market is you have like a ton of attention. Like you have tons of people who are like playing video games, but from an advertisement standpoint, like they're not really monetizing it that well. But again, I feel like if you're one of the Saudi, like it's more the influence, right? And again, like the actual structure of the leverage buyout, putting in a 65% equity check makes it harder to make the math work to get the IRRs that, for example, a Silver Lake is targeting. So I wonder if they're getting some kind of like preferential structure that they're getting doing this deal, because they are going to be the one that has to like operate the business and run it and all that kind of fun stuff. Especially if you then look at Affinity Partners, like I'm not really sure what they're bringing to the table because it's Jared Kushner's private equity firm. They have like, I think like 5 billion. I mean, again, this is according to ChatGPT. I was trying to look this up before we started. I mean, it looks like they have $5 billion or so in assets under management. They started in 2021. So like, I'm a little confused what their role is in here. Cause like, do you really need that? I mean, it's a $36 billion. Like the, Saudis have a ton of money with PIF. And then you have like Silver Lake, but like, what does Affinity Partners bring to the table? So I'm a little confused about what they're doing, but the main takeaway is comparison from 2007. This, I would say, is much more of like a co-invest type of structure versus your sort of traditional club deal consortium of private equity firms. But anyway, we just went through a lot of stuff. Like we talked about CLOs and anyway, way too much stuff. And we're 42 minutes in. So I'm going to shut up for a minute. Anything else, Jen, that you thought was interesting about this deal that you wanted to touch on before we talk about Fed funds? Okay. All right. Jen, all you.
No, we'll make this quick. We touched on this last week, and I just wanted to explain a little bit more because I was literally reading the article as we went into recording. So just to be clear, again, Dallas Fed President Lori Logan, who is not currently an FOMC voting member, but will be in 2026. This is not her first time speaking about this. This is not anyone's first time speaking about this, but it's starting to gain traction, this conversation about basically ditching the federal funds rate. And I think in order to really understand why I personally support this as a move and why I think it has so much buy-in is to go back in time pre-global financial crisis. So before 2008, the Fed funds market was actually a very robust market. And what's the Fed funds market? This is commercial banks, effectively, like big financial depository institutions lending to one another in the overnight market. And when those loans would happen all the time, you would get, right, okay, well, what's the actual interest rate happening at those loans, right? And we all have talked about ad infinitum, the tools that the Fed has in order to keep that interest rate at the Fed funds target rate, which was a rate at the time and not a rate range. But going back, you can listen to other podcasts to learn about that. You can take our course, whatever you want. But the bottom line is there were a lot of actual observed transactions in that market. Then 2008 happened. And the Fed did, well, two things really happened as a result of 2008. But one, the immediate effect was that the Fed pumped so much cash into the system that these banks were awash with cash. They don't need to borrow and lend from each other anymore. They got banks, they got cash out the wazoo. And you want to earn some interest on that money. Otherwise, it's not helping you. So they could now all of a sudden go park it at the Fed, right? And again, at the time, Fed had cut rates to a 0 to 0.25% target rate range, right? We implemented that range so that rates would not go negative. You could go park it at the Fed and earn something on it there, right? That's very different from lending and borrowing with one another. And It's been 17 years since then, and the federal funds market has not really recovered in terms of how much it's used. You get like the federal home loan banks who use it, but like that's about it. So daily transactions in the Fed fund market are something on the order of magnitude, according to Bloomberg, of like $100 billion a day. That sounds like a lot of money, but it ain't compared to the repo markets, which we've talked about here. I feel like all I talk about is repo these days. I never thought this would be my life, but that is
Jen, the repo expert.
The repo expert. This is the collateralized market, collateralized by high quality collateral like US Treasuries, where people make loans either overnight or in term to one another, collateralized by US Treasuries, sometimes by corporate bonds, by all these things. But it's basically people who are borrowing money to go buy bonds and then pledging those bonds as collateral for the loan, or this is the market through which people finance shorts in the fixed income market. There are trillions and trillions of dollars of volume going through in the repo markets every single day, oftentimes at what's called the general collateral rate. You'll hear people talk about like the tri-party repo. All you need to know is it's just these loans, okay? How many people are involved in the loans? What goes through a bank? Like the actual mechanics and the weeds are so freaking boring. You just don't need to know. Just know GC, general collateral repo rate, okay? GC, overnight GC, term GC. That's what the repo market is. Now, after 2008, something else happened. We didn't just have the Fed funds effective rate, right? We didn't just have the Fed funds target rate. We had to think about, okay, well, here's where banks are borrowing and lending overnight. What about for 3 months, 6 months, 9 months, 12 months? We had rates for that. How were those rates determined? Well, we had something called LIBOR. We had the London Interbank Offered Rate, where every single morning, a bunch of banks would be polled and say, hey, where would you guys borrow and lend to each other for 3 months? Like, let us know in the comments. Go enter it into a Survey Monkey and let us know. And this rate, compiled by all these banks, would be the underlying index that determined the valuation of trillions and trillions of dollars globally for loans and for derivative contracts. Well, during the financial crisis, every morning.
Just to add, like you used to like kind of joke about this. It's like, where do you identify? Like,
well,
how
that's
much?
What I'm saying. Yeah,
yeah. It's like someone just was like, this is
rate.
where I think I would. Yeah.
Yes.
Like,
it wasn't an observed rate. It was a reported rate. That's very different, right? It wasn't saying where are LIBOR-based transactions happening. It was saying, well, what do you think you'd lend at, or where do you think you could borrow? Yeah. And so during the financial crisis, what has been alleged by the courts. I know there's like, actually, I think one of these convictions just got overturned. But anyways, what was alleged to have happened was that individual desks at these banks said, oh God, things are really bad. We could actually borrow. It would cost like 10% to do this, to borrow for 3 months. But I don't want anyone to think I'm in trouble. So I'm just going to say things are fine. I'm going to say instead of borrowing at 10%, I could borrow still at 5.25% every day. And there were accusations of manipulation in the LIBOR market. And we're not here to talk about the LIBOR scandal, but what's important to note is that those are the shortcomings of a reported rate versus an observed rate. So after the LIBOR scandal, when faith was broken, this didn't happen like yesterday. Right? These actions took place during the global financial crisis of 2008. Over the next freaking 15 years, the courts and the regulators said, we got to do away with LIBOR. We got to find something else. Okay, well, what other rate did we have? The Fed funds rate, right? There we go. We got the Fed funds rate. Well, they didn't use the Fed funds rate. Why not? Because there just weren't that many observed transactions in it. So you'd go from one reported rate to an observed rate that didn't have a ton of volume trading. So where did they go instead? Well, they said, well, guess what? Look at the repo market, right? There are massive, massive amounts of notional volume going through in the repo markets every day. Let's use that observed rate. So that's where they came up with SOFR, the Secured Overnight Funding Rate, which is effectively the daily average of all those transactions that happen at the general collateral rate. Okay, so that's what we have as our new LIBOR. But that wasn't implemented. The switch wasn't fully made until June, I think, of 2023. That's how long it took to make this switch, okay? Mm-hmm. So like from the inkling of doubt about LIBOR's vulnerability until the switch being made was all told something like 15 years. That's a really, really long time frame because there's so many things that have to get in motion, right? And all of this was sparked by the global financial crisis. So now here we are. And we're in a period of relative stability in the markets. We're not in a crisis. As much as I warned about the potential dangers of Apocalypse 2.0, What we're seeing is a pickup in funding stress in the market. So I think as of this morning, like spot Fed funds GC or Fed funds SOFR is like -11 or something like that. I think when we first talked a couple of weeks ago, it was like -6 or 7 or 3 or 5. And, it's continued to get more negative. And that's calculated as Fed funds minus SOFR. So if Fed funds is 4%, and SOFR is 5%, right? Fed funds minus SOFR will be -100 basis points, right? So the more you get charged in the repo markets, the more negative that spread will be. So more negative Fed funds SOFR is an increased indicator of stress in the system. So it's negative right now, but it's not crazy negative. It's just slowly been creeping more negative. We've talked a lot about the potential reasons for that. We don't need to get into it here. But the bottom line is we're in a period of relative stability. So what Lori Logan and what others, I know Chamath has talked about this a lot on the All In podcast, are proposing is, let's say, hey, why are we having the Federal Reserve use the Fed funds effective rate, where only whatever it is, right, $100 billion of trades happen every day, as their primary transmission mechanism for monetary policy? Why are we having them use that? Why aren't we having them use something like GC, right? Like the general collateral repo rate to be the rate that they use for that transmission of monetary policy.
Can I ask a question though? I mean, my assumption, and then correct me if I'm wrong, is that they control Fed funds, whereas like I assume they're not controlling GC. It's just the observed thing. So then they wouldn't, or do they control GC somehow?
We have the standing repo facility and we have the reverse repo facility. The Fed
and they do have their hand on that?
Their toolkits. Well, that's
okay.
What the whole thing is, right? The reverse repo facility is where you can go and you can lend money to the Fed as the borrower of last resort. And they guarantee you that they will pay you the floor on the Fed funds effective rate, right? On the Fed funds rate range. You also have the standing repo facility, which was put in place in 2019 after the repo apocalypse, the repocalypse, to say, hey, listen, if you are a bank and you can't borrow money, you can come to us. And they already had the discount window in place for that too.
So I guess my question then is, since, look, to your point, the Fed funds rate literally is just, it doesn't affect a lot of things, but I feel like most people, well, they take their signal from whatever Jerome Powell says they want to be setting Fed funds at. Ultimately, the market's going to do whatever the market's going to do. I guess what impact would moving from, say, Fed funds to GC, since they're kind of already controlling it anyway, is it just giving a little more precision to like their, like what effect would that have? I guess
it's a number of things, right? So Fed funds effective doesn't move because it doesn't trade, right? So what does it matter if you move the Fed funds rate when you have these other things as emergency facilities to keep GC from going totally crazy, but they aren't part of the Fed's day-to-day toolkit and they aren't the rate the Fed is setting, right? So just because the two happen to trade on top of each other now doesn't mean that they will in perpetuity. And they're 11 basis points apart. What's to stop them from being 50 basis points apart? What's to stop them from being 75 basis points apart, right? That spread is a freely floating thing. So if the Fed, and by the way, the Fed every single day calls the banks and they're like, what the fuck's going on in the GC market today? Like, tell us. We need to know. We're watching this. They are watching GC as the measure of funding stress. They're not watching the Fed funds rate.
No, totally understood. But
so why don't they, in addition to, they could set the Fed funds rate. They could also set GC. They could just say, hey, we want it to be in this target rate range. But they don't right now. It can go anywhere they want it to. It's just that they have these facilities in place in case of emergency to prevent a financial crisis in the US, but they're not controlling.
So you're saying instead of having this like mechanism that then supposed to trickle into GC, which then supposed to trickle into everything else, like instead of having this thing be the beacon, it's like, let's actually put our hand on the wheel instead of like hoping that we sort of do some magic voodoo and someone takes the wheel and drives that direction. Just fucking put your hands on the wheel.
Cliff, we're here to catch them.
Yeah. Oh, that makes sense. Yeah, that makes sense. I'm all for this. This makes sense to me.
Right. So rather than setting this like
random rate,
exactly, like gesture of a rate, which you can still do, by the way. Go ahead, set Fed. I'm not going to stop you.
Yeah.
Why don't you set these other things as well? Why
not have it be something that's much more like in control of the economy?
Set the rate that matters, not the rate that doesn't, and just pray. Right? If you're already watching this, it's not like this is some new thing. The Fed's didn't wake up yesterday and be like, well, look at GC. Like No, they're looking at this all day, every day. They're really concerned about changes in GC. They're really concerned about liquidity there because they are the people who then have to step in and fix everything if it blows out, because they do have this promise in place. Like, don't worry, if this blows out to 10%, you can come to us. But like, I hope it doesn't,
Interesting.
Just set that rate.
Interesting.
If that's what you're so worried about.
You've convinced me.
So
I didn't really understand like why they were talking about this last week. I was like, cool, this is an interesting thought experiment, but like why?
It wasn't clear in just, I didn't have time to kind of go through the logic of why SOFR is SOFR and why SOFR isn't just Fed funds effective. OIS, what that was called. Like we used to use, but it's just that those rates don't matter in reality. So let's use rates that matter in reality. And her point was, again, it took basically 10 years after they decided to abandon LIBOR and put that into place. This isn't a switch you can flip overnight, as much as we're in an era where we are changing things very quickly. I think the reality is that's a switch you can't just flip overnight. So let's get the mechanics in place now, rather than waiting for a crisis in the funding markets to arise and then be trying to make this switch under those circumstances. Then too late.
Yep. All right. Well, anyway, you've convinced me. So this is very interesting. I found that fascinating. I love learning stuff. So I definitely, that makes complete sense. Well, thank you everyone. So quickly, this is going to be like a 1-2 punch. So we have our episode today, which is obviously Jen and I talking about the markets and big deals. We also have an interview with the head of a $1.4 trillion, or she's not the head of the asset management firm itself. She's head of quantitative equities at. And how much does she oversee in terms of assets?
60 billion. So she oversees 60 billion in assets in this quantitative equities strategy at PGIM. So this is for everyone who is like, I want to be a quant. How do I get into quant investing? This is for you. Now, I will say this is not our first and this is not our last episode on the quant front. We did a very early episode on quant investing with Professor Harry Mamaisky. And we will be doing additional episodes to talk about other aspects of quant investing. Go ahead.
And we also did an interview with Pete Muller, who was the founder of PDT Partners.
Oh my God, how did I forget about Pete? Jesus, yeah.
So we have a couple of episodes on.
Oh my God, we interviewed like the most successful quant investor of all time, and Jen completely blanked on that. Like episode 11 of the podcast. Yeah, you want to learn about quant investing? Go back and listen to Pete Muller's episode. That's a good one as well. But we will have more of these, and the episode that we're talking about specifically here is incorporating systematic investing in a quant strategy alongside other parts of your portfolio and thinking about it really holistically. I think Stacey did a great job answering our questions on this front. But this is distinct from, say, super high frequency trading where you're trying to get in between the wall and the wallpaper on like infinitely
like a J Street,
things exactly that happen. So we will do more content on that as well. But this is more like, this is like the bread and butter quant stuff. This is like quant for everyone,
Yeah.
Like, yeah.
Not for the people who can't get into Pete Muller's hedge fund or to run tech. And yeah.
I mean, listen, it's not like this is an easy job to break into.
Sorry, when I say get in, I mean into their hedge funds.
Investors who can't, those
you
guys
cannot.
They don't want your money.
They don't want your money. They are
PDT not taking
family
your money.
like they're closed. They're closed for business. PGIM, you can invest in the quantitative strategies under their umbrella. So that's
Awesome. Well, all right, everyone, have a great weekend. And remember to check out those live virtual boot camps that we have. Next up is at the end of the month, so you have plenty of time to prepare. So go to our website, thewallstreetskinny.com, go to live classes, and you can register yourself or the people who work for you there.
Awesome. We'll see you in a day or two.
Okay, bye.
Bye.